In 1994, the bond market collapsed overnight, erasing trillions in wealth. Few saw it coming, like a ticking time bomb suddenly going off. Today, the yield curve is inverting, risk premiums are rising, and U.S. debt has soared to $37 trillion, growing by $3.65 trillion annually. The patterns are eerily similar, but the stakes are far higher. I've analyzed data from Morgan Stanley, JPMorgan, and the Federal Reserve, institutions renowned for their market insights, to uncover the signals that preceded past bond crises. Stay with me to explore the historical parallels and learn how to prepare for what's ahead. The 1994 bond massacre, a warning from history. Imagine waking up to find your bond portfolio lost 20% in a month. That's what happened in 1994 when the Federal Reserve shocked markets with rapid interest rate hikes. Investors who thought they were playing it safe suddenly saw their stable bond holdings evaporate. After years of low rates, the Fed changed course aggressively, raising rates 7 times in just 12 months. The parallels to today are striking. Back then, investors grew complacent after years of low interest rates, assuming the good times would last forever. Today, we're hearing a similar, higher for longer narrative, with many convinced that rates will stay elevated but stable. But history shows that when debt levels are high and inflation lingers, stability is often an illusion. Take the story of one investor during the 1994 crash. A retiree who had shifted his savings into long-term bonds for safety saw his portfolio shrink by nearly a quarter in just weeks. He had planned to live off the steady income from his investments, but the sudden losses forced him to rethink his entire retirement strategy. Stories like his were all too common, as the speed of the Fed's moves caught even seasoned investors off guard. The 1994 bond massacre didn't just hurt individuals, it toppled institutions. Orange County, California, went bankrupt after its treasurer borrowed heavily to amplify returns, betting rates would stay low. When the Fed acted, $1.6 billion in losses piled up, marking the largest municipal bankruptcy in U.S. history at the time. The key takeaway? Leverage and complacency are a dangerous mix when the Fed shifts gears. What made 1994 so brutal was the speed of the rate hikes. The federal funds rate jumped from 3% to 6% in less than a year. Bond prices, which move inversely to yields, collapsed. Long-term treasuries lost nearly 20% of their value in months. Investors who thought bonds were the safe part of their portfolios got a rude awakening. Fast forward to today, and the setup looks eerily similar. After more than a decade of near-zero rates, the Fed has been hiking aggressively to fight inflation. The difference? Debt levels are far higher. In 1994, U.S. federal debt was around $4.6 trillion, about 65% of GDP. Today, it's $37 trillion, with debt to GDP well over 120%. Even small rate moves now have a much bigger impact. The lesson from 1994 is clear. Never assume stability when debt is this high.